Today on Turpentine VC, we have a slightly different format. I sit down with Alex Edelson from Slipstream Investors and pitch the creation of a new fund to get his reaction and insights. We cover portfolio construction, strategy, and how to prove out the concept, all based on Turpentine's master plan. You can find a link to it in the description. Alex, the founder and general partner at Slipstream, specializes in investing in top early-stage venture capital funds that are difficult to find. Prior to that, he was at QED. Here's our conversation. First off, thanks for jamming with me and giving me some early feedback as I think about where to take this.
Yeah, thanks for having me on.
So punchline is wondering about the future of Turpentine and how it could be used as a potential fund asset. For quick background, helped start Village Global and spent 7 years there and made a bunch of investments. Also helped start On Deck and was first employee at Product Hunt. So have operating experience, have investing experience, have a strong track record. And now, the Turpentine learning is actually built on the On Deck learning a little bit, which is On Deck built these first On Deck was an investing asset in that we were seeing founders before they started companies, and that was helpful. Product Hunt was also an investing asset in that we could provide startups with distribution. And so people wanted us to be on the cap table, basically. And so in terms of sourcing and winning, both of those were helpful because we were seeing things early and there was some advantage, whether it was distribution with Product Hunt or recruiting with On Deck, recruiting early and talent or co-founders. So I like that idea of building assets that are helpful to investing, that kind of work in your sleep. Otherwise, I'm just a guy, just like anyone else is a guy. And so that's the one thing that inspires me at Turpentine. Another thing that's inspired on the learning of On Deck was these vertical communities. But as vertical communities get bigger, sometimes the network effects, they're actually negative network effects. Communities can get diluted as they grow. And since we raised venture, we had to sort of scale them, and it wasn't the right incentive mechanism. So Turpentine has not raised any venture, and not planning to raise any venture. But also, I was looking at Lenny Rachitsky's business. He's got this product management newsletter and podcast that does a few $1 million a year. It's very successful. And I was comparing that to our product management community, and I was like, his business can get bigger, and there are no negative network effects. He doesn't have to worry about the person reading his newsletter, the incremental. He's got 600,000 subscribers now. If anything, maybe it gets better because he's now getting sucking up data from them and sharing that data back in surveys and stuff like that. So I was like, instead of vertical communities, I want to build vertical media properties, like what Harry Stebbings has done in VC or Lenny has done for product managers, and do them for every sort of enterprise buyer position. Basically, I could own these unique audiences of hundreds or thousands of HR people or CFOs or sort of positions that people would want to sell to. And then also I could do it among different sectors as well, to develop sort of expertise there. And it would serve one as a distribution platform. So for companies looking to sell to certain positions, or even just get in front of the tech founders or tech audience. So that would be helpful for investing. But then also, since part of the media is doing diligence, maybe we could build this army of researchers that do diligence as a service, basically, and we should trade on that or invest on that diligence, and we don't have to have a big fund to do it. So we could have a $50 million fund or $100 million fund, or I'm just naming random numbers. We could have a smaller fund, but have the resources of $1 billion fund, at least in terms of diligence. So I'm curious to get your perspective. If Turpentine succeeds in its media goals, and we're off to a decent start, goals of providing distribution, owning niche audiences of enterprise buyers, creating this diligence arm, that we're at the very beginning stages of that specific part. What type of investment property, if at all, should we create on that? We have some examples, of media to invest in. Obviously, Harry Stebbings, obviously Packy McCormick, Lenny himself has a very active investing practice. And so you've seen these in the market. And Andreessen, of course, talks about being a media company that monetizes through venture. Anyways, I'll pause here. I just wanted to set the scene a bit.
Yeah, it's great. I mean, super interesting. I have a lot of thoughts, and like in fairness, like I didn't come into this knowing a lot about the strategy here, so
You're hearing it for the first
so
time.
I'm kind of riffing here, but no, I think it's really compelling. I think the question is like one, like, is it a unique edge that founders of companies in some sector and at some stage um, would be compelled by? Like, would they be motivated to work with you because of what you've built or what you are building? Like, at some point in the evolution of what you're building, will this appeal to them and make them want you to be involved in their companies financially? And like, will they want you to invest? And so, um, yeah, the questions on my mind are like, okay, there are a lot of different types of founders, types of companies. I could imagine this being helpful to. And so then like your first question is like, okay, it's like, well, with whom do we have an advantage that's like unique to us? And like when does that advantage kick in? Like, is it pre-seed stage? Is it like, you know, early indications of product market fit? Is it like post product market fit and scaling? Like when um when is the right time in a company's evolution to take advantage of you know what you're offering, um and then it's like from just a strategic investment standpoint, once you just kind of figure out like, hey, what stage are we playing at? It's like, okay, so like let's just assume for a minute that you can source, because like at some point like this becomes a well-known brand, like people are going to know you exist. And if you're showing that you can add a lot of value and founders are excited about your involvement, like that will also help deal flow. And so and you should then the question's like, all right, well, like let's talk a little portfolio construction. Like, should you be the ones leading any of the rounds that you're investing in? Like, does that make sense here? Or is it more like, no, it always makes sense to let them in as like a collaborative participating check-in around. um, they're not taking a ton of the capacity in the round and they're adding disproportionate value. um, of course, like no brainer, we'd want them in. So it's like, hey, would you do, let's say you think the right stage is like seed or A, and you're like, hey, we just write $250,000 checks. It's like, sure, no brainer if you're adding a ton of value. Like, why not let them in for 250? But then you have to like get the portfolio construction, right? Like how many shots on goal and what's your check size and what kind of, how you think about ownership and does it make sense to follow on? And um, those are the things that come to mind. Like the answer is like, of course, it seems like you could be very valuable to founders, and that you have a unique edge. It's built around primarily the value to founders, but other things too. I mean, you end up having a lot of um, interesting information about what's going on in the market. And one thing that comes to mind, and then I'll stop talking, is like sometimes VCs are talking to lots of companies who are competitors, and they are trusted to not share um, information about the companies, because it would be like inappropriate and potentially competitively sensitive. Um, and so you would hope that they wouldn't share. And I think often they don't share. And so then the question is like, no, but your whole business model is like kind of sharing.
Yeah.
And so, does that create some chilling effect where people are like, actually, like, I don't want to go through this process because if I do, like, their diligence may reveal that, like, we're not actually, one of the best products in the market right now. And then how will we overcome that? And there might be an answer like, well, that's the break. It was the breaks. Like, if you're not one of the best, like, I guess you probably like there's like maybe you shouldn't win. But would that create a chilling effect? I don't know. Anyway, I should stop talking.
No, these are great points. Yeah, we'd have to have some church and state between the media and the investing. That would be a thing to navigate for sure. I mean, we're definitely in sort of the pro tech media thing, and if we're going to be doing like, hey, these are the best note taking product lists of best products, whether a company's on our cap table or not, they're going to be rated somewhere, or, ranked somewhere. And us being on the cap table is going to worsen the chances of being listed. But yeah, it would affect our credibility to the extent that, Packy McCormick or Harry Stebbings' credibility is affected when they're on the cap table of something, which I think people are just like we're not claiming to be journalists. I think people are sympathetic to just like, hey, there are people who create media and they invest in startups and they disclose when they invest, and they're more likely to say good things about startups they're invested in, and that causality works both ways. Like because they believe that the startup is good, they invested, and also because they're invested, they're likely to just largely champion this kind of thing. But yeah, it's definitely something for us to figure out. Let me start by a thought experiment. If Harry Stebbings is on the call with us, just because his media property has been going for longer, though I think we're up there in terms of in parallel in terms of overall numbers. What do you think? Like, what type of portfolio construction or strategy makes most sense for someone like him, in your mind? And just the other side, we've seen Packy actually evolve his portfolio construction over time. In the beginning, he was doing smaller checks in, I think, like 100 to 200 companies per fund, almost like the Village Global model, which I think is 200, or I think this most recent fund, I think it's like 200 companies, or I'll take this out of the podcast, but it's something like 200. If we release one, no pressure, something like 200 plus like 5% ownership, or 5% ownership average. Sometimes it's 10, sometimes a little bit less if they can't get it, but that's what they try to do, and they try to be the second biggest check. And Packy was doing even smaller than that, smaller ownership, but a lot of checks. And now I think he's like 30 checks, like, much more consolidated position. I don't know if he's leading or co-leading, but, and then Harry, I think, is writing big checks. I mean, he's a big fund. Anyways, I'll pause there for any reactions on
Yeah,
comparison.
well, I don't know. I don't know that I know enough about Harry's business. I mean, I'm a fan of the podcast, but I don't know enough to opine on what's the right strategy for him. But I guess I'd like turn the table for like a little more information before I weigh in here. First would be like, at what stage do you think it would make sense for you to invest?
Yeah. Okay, so there's me and then there's Turpentine. I think for me as a GP, I think pre-seed and seed makes the most sense. Maybe a little bit of A, but like that's what I've done my whole career. That's where my track record is. That's where I enjoy the most. That's where I think, yeah, a lot of the alpha is there for me personally. For the media property, it's not clear. Yeah, I'm curious if you have a reaction. Like, if there would be, like, if we're really getting diligence on companies and getting insights from employees and stuff like that, like, I could make an argument as to later stage, like maybe we just have better data, and if we're getting better data, data matters later stage because earlier stage is a lot about people and sort of direction of the market and sort of an ability. But like, so I could make an argument more holistically. But if it's just personnel of me, barring me getting some partner, though, we do see like Harry is probably doing early stage and some growth, and he's probably going to get a growth guy. Like like the most ambitious people do build franchises and bring in the relevant talent. Um, but I think the media could be helpful across the stack, though it's possible that's a cope, and I should, or that's not, like, maybe that's not the best answer, and I should get more specific. What do you think?
Well, no, I mean, like, yeah, it depends in part on like what you think is most fruitful for the core business, and then like you build this around that. And so like if what's most interesting to folks is to like see cutting edge new technology that may resonate with them, then you're like potentially initial customer intros, design partners. Like you could make an argument this is like a pre-seed seed stage fund where like we sort of test it in the open. We test interest. We're kind of like doing some early customer research, even though these folks, like you can kind of call it like almost pre-testing for product market fit. And then, when you make an investment that potential buyers seem excited about a product like this, right? And as far along as you can get into sort of pre-qualifying for product market fit, the better. So it's probably not like totally deck in a dream stage. So it's probably not like pre-seed.
Yeah,
I mean, how you define pre-seed? I don't mean to be
yeah,
silly about the distinction between pre-seed and seed, but it's probably where there's something that if you could put it in front of someone, they could say, yeah, like that resonates. We would be interested in buying something like that. Um, but and so that if that's where this ends up going, like, hey, we talk about new and innovative things that should be on a CFO's or like head of HR or someone's um, like list of potential tech to learn about and maybe buy. Um, then I think this feels like a seed, maybe an A fund, and then there are like challenges there, right? Like higher loss rates. You'd have a smaller fund. So like, is the juice worth the squeeze on a smaller fund for you when you've got like a successful media business that may be generating, much more meaningful like economic outcomes than a small fund could create for you.
Right.
Um, and then a lot of these things are related, right? So like you might be more comfortable being less concentrated but smaller fund, which may be less compelling to you, doing an earlier stage strategy if you think that's where the edge is, where founders will feel like they really want to work with you, is at that stage in their evolution. Then you can make an argument like, no, we're post product market fit. We are finding companies that they are just hitting it. Let's say it's like, I don't know, A or early B, and they're like really starting to take off. We can help those companies go from like meaningful revenue, like growing, doing well, to like escape velocity in terms of sales. Um, I think that's really compelling too. I think that's probably a more concentrated portfolio,
Yeah.
where you're really playing for like category winners, and a lot of folks may at that point kind of know who are the most likely winners, and so you're fighting for an allocation, and you have a unique edge to win one, and you have larger rounds, so you can put more money to work, and you can have a bigger fund, which might be more meaningful to you, and might justify like the effort, and just like brain damage that comes with like start standing up a whole venture firm. Um, so yeah, I'm not sure I have an answer to the question. I'm kind of just talking out loud about how I might think about it.
Hey, we'll continue our interview in a moment after a word from our sponsors. Over 100 startups launched today. Do you know who they are? If you're not seeing interesting startups, none of your downstream processes matter. How you source deals at the earliest stages could be your most consequential investment. Harmonic is the most complete startup database, finding new companies as soon as they incorporate and tracking them through IPO. You can create a search tailored to your investment thesis. In one search, filter over company data, including venture stage, industry, and geography, founders and operators' backgrounds, and traction metrics like headcount changes, social media audience, and web traffic growth. Importantly, Harmonic instantly surfaces warm connections to help you connect with founders. The results are delivered on autopilot, wherever you most need them, over Slack, email, or via API, directly into your CRM, integrating seamlessly into your software stack. Learn why Craft, Bedrock, NEA, and hundreds more trust Harmonic's data by visiting harmonic.ai or use the link in the description. Make sure you mention our podcast, Turpentine VC, during your demo. Hey all, Erik Torenberg here. I'm hearing more and more that founders want to get profitable and do more with less, especially with engineering. Listen, I love your 30-year-old ex-FANG senior software engineer as much as the next guy, but honestly, I can't afford them anymore. Founders everywhere are trying to turn to global talent, but boy, is it a hassle to do at scale, from sourcing to interviewing to on-the-ground operations and management. That's why I teamed up with Sean Lanahan, who's been building engineering teams in Vietnam at a very high level for over 5 years to help you access global engineering without the headache. Squad, Sean's new company, takes care of sourcing, legal compliance, and local HR for global talent so you don't have to. Their engineers follow your process and use your tools. They work with React, Next.js, or your favorite front-end frameworks. And on the back end, they're experts at Node, Python, Java, and anything under the sun. Full disclosure, it's going to cost more than the random person you found on Upwork that's doing 2 hours of work per week but billing you for 40. But you'll get premium quality at a fraction of the typical cost. Our engineers are vetted top 1% talent and actually working hard for you every day. Increase your velocity without amping up burn. Head to ChooseSquad.com and mention Turpentine to skip the waitlist. That's ChooseSquad.com. My sense is that the sort of LPs want to back managers who, um, get have more concentrated portfolios with higher ownership. Is my sense, having done the Village thing around, like, you know, Village fundraising didn't get easy until Fund Three, when they already had markups from the strategy, but people weren't thrilled at the high volume sort of, even at 5% ownership, like, is just not what they're used to, or not what folks like. Is is that is that fair to say that fewer companies, higher ownership, you know, is what is more palatable for folks like yourself?
I mean, yeah, so I'll speak for myself, but I can speak generally too. Like, I don't think there's one answer there in terms of what LPs prefer. Like, I have my own preference about what I'm looking for and what I've seen work over, like, across many vintages, and in my, from what I can tell, like, kind of like the evolution of venture over the last 15 or 20 years. But like, I don't think there's necessarily one answer. So like, there are certainly family offices and other folks who like very low concentration strategies. They want to take a lot of shots on goal. They want to they want to get the chance of getting a big outlier, and even limited, even low ownership relative to fund size in a big win is great for them. And I think there are successful examples of funds who are lower concentration and get lower ownership relative to fund size that have done really well over many vintages. Yeah, like I'm personally drawn to funds that are getting higher ownership relative to fund size. That often is correlated with, a little more concentration, but like, I guess the challenge is like, figuring out what the right level of concentration is. I'd say like I'm thinking about this in a few different ways. One is um, enough ownership relative to your fund size. So it's not just like high ownership; it's high ownership relative to fund size. So like 3 or 4% ownership on like a $10 to $15 million fund is very high ownership relative to that fund size. But you might not think about that as a high ownership fund. Whereas like 10 to 15% ownership is what people are typically thinking when they talk about high ownership funds. But if it's 10 or 15% in like a $300 million fund, I'd be like, that ownership is not like that high relative to the fund size. If you were doing that on a $50 to $75 million fund, let's say, yeah, 10 to 15% ownership is very high relative to fund size. So I don't think there's like one answer. I think about ownership relative to fund size, and I think about shots on goal as unique to like the opportunity set. Like if you said like we're playing in a space where there aren't that many winners every year, I'd be like, well, you might want to be more like be careful. Like then you may not have many winners. Um, and I also think about like when I'm thinking about ownership amount, I'm thinking about like what is a reasonable set of outcomes we could expect here. Um, and then relative to the fund size, you're thinking, okay, so like if we're being conservative about the outcomes we're underwriting to here in terms of like companies' exit valuation, um, can the more modest outcomes be meaningful to fund level returns because you have enough ownership relative to the size of your fund, such that even if you don't get the big outlier winners that you think are possible but are pretty unlikely, it'll still be a good fund. And then if you do get those big winners, then it's an amazing fund. Um, that's the level of ownership I'm typically looking for. Is the more modest outcomes that are still successful can have a meaningful impact on fund level returns. And I think that's what many LPs would be thinking when they're thinking about ownership and fund size. Although I should speak for myself on this, but yeah, like there's a bandwidth issue too. It's like, but like how many companies can you get to conviction on, and how many can you source, diligence, get to conviction on, and to the extent you want to work with them after they invest, like there is, it seems like as part of the strategy, a significant component is like working with them and helping them like get to customers. And so, how many can you work with and add value at a level that would like meet their expectations and like keep those founders excited and saying good things about you to other founders. So I think I basically just took your question and like didn't answer it. I think I just talked about the question. So I'm
But
not sure how useful that is. But I don't think there's like one answer here. I think it depends on,
yeah,
I guess I think about it in the way I just described.
That makes sense. And to bring in another example, Product Hunt, which I helped get off the ground. This guy Josh Buckley, who's a good friend and a great guy and a great investor, he took that asset and created an accelerator on top of that. He didn't, that was sort of the people were more gung ho about accelerators. They ended up not continuing it because he was having more success with his later stage investing. But you could imagine they also could have just Jack Altman's most recent fund, what's it, 150 million, pretty standard, I think, portfolio construction, pretty concentrated, I think. And you could imagine Product Hunt trying to do something like that too. So it's I think these things are assets that you could sort of like justify as long as the team is strong, and there is a clear narrative, but you could use the narrative a few different ways, or you could spin a couple different narratives that might be pretty strong. My sense is, to your point, I'd want to do this if this is worth a while. Like the media company, I think is going to do very well, and you definitely want to be investing. But if it's a small fund, I could just do just angel invest. So
Right.
we'd want to take capital if it's worth worth the brain damage, as you might have alluded to. And so my sense is we do want to be leading or getting high ownership as a percentage of fund size, and that's probably 10% in some series of some set of companies. And we use the pitch of, hey, we'll help you validate if it's early, we'll help you get customers, and we'll help you, we're like a reputation definer in the industry. And so we're trying to king make, and the people we king make, we want to have investment stake in.
Yeah.
So, and for some of those companies, we'll be able to ride that up, and for other, ride it over time. And for other companies, we'll probably be late into, but they'd want, maybe they'd let us on the cap table if we can help solidify their position as the best late stage whatever HR company or whatever it is.
Okay. I mean, that resonates. And like that to me feels like a seed and maybe a fund. And like opportunistically going a little later, probably not going much earlier. And I think like if you're taking 10%, let's just throw that out there. Let's say this is a, 75 to $150 million fund. Um, and there's enough room in terms of like how much ownership you're taking in around for another meaningful investor or other smaller investors to play. And yeah, like in a perfect world to me, I mean, this is just me, but like the early stage funds, you want to be like slightly lower concentration. If you were to say like, oh, this is like a series B, C, D, I'd be like, see if you, I don't know, 20 names. That would be interesting. I mean, that's not really where I play, so I shouldn't. I'm like talking a little out of turn here, but that would be more. That would resonate more with me because it's like you're really playing for the category winners.
Yeah.
Whereas like here, it's like you don't necessarily know yet who's the category winner,
Yep.
and maybe you want 25 to 35 investments. I mean, I think it would be hard to do much more. I'd be surprised if you did a lot more than 35. But I don't know. Maybe you could. Um, and I think, yeah, I mean, I think this is, I think, I think you'd want, if you did much less than like 15 or 20, I'd be like, oh, that seems pretty
Yeah.
concentrated. But you're right that when you say that LPs aren't intrigued or like excited about more concentrated funds, I mean, I guess like if we just step back like to like the theoretical level, it's like, well, yeah, if you could put like all your money into like your one winner, like I guess that would be best. And
Yeah.
so people who have like the courage to be concentrated, if you can get to conviction on their ability to source deals that are good enough and be good pickers, then yeah, there's like you can get comfort with more concentration, and then it's like it can be high ownership relative to like uncommonly high ownership relative to fund size. So I wouldn't call like 30 or 35 companies like very concentrated. I'd call that like kind of in the middle.
Yes.
Um,
Yes.
but I think it would be appealing. So then the question for you, in terms of concentration, would be like, do you think that the model that you have built, like the business that you have built, um, that you are wrapping this venture fund around, essentially. Um, does that help you become like a significantly better picker? And I think like the answer is probably yeah. It should help your picking. And so if you feel like it makes you a much better picker than like or like a top decile picker at like the seed and A stage, then there's an argument that like yeah, trending a little more concentrated may make sense.
Yeah.
But yeah,
Well, yeah, I think it's interesting because it makes us a better picker in theory. Being able to have more customer references, more data on the company, um, should make us a better picker. That said, also it should make us the media company should make if it's successful should make us a better sourcer too. So we'll be able to see more of the landscape, and then also be able to help more in theory if we build out this sort of platform as a service. Type thing. And so I that would be an argument in favor of maybe more companies if you're seeing more and you're not as constrained as a normal two-person shop on the ability to help. So I could see the argument going both ways a little bit.
yeah, I think that's right. And then part of the answer depends on like sectors you're playing in and like how broad of a focus do you have. Like it feels like what you're describing is kind of B2B SaaS, but it could feel like fintech or healthcare or it's probably not like hardware or there's certain sectors it's probably not, but
Yeah,
it could be a lot of sectors. So like I guess the broader it is from a sector focus,
yeah,
then that also weighs in favor of maybe being slightly broader. Because
yeah,
because then like when you get sector focused, it's like to some extent you have to like make some bets. It's like okay, you're a fintech focused fund. Like how many neobanks can you invest in? Like they're gonna start not wanting you to invest in other neobanks.
yeah.
you
Yeah, no,
know.
I think we're going to want to be broadly generalist, and I think the way we do that is we create sort of these shows or media properties across a bunch of different sectors, so that we have expertise or insights across a bunch and are not constrained, and can double down where we notice opportunities and stuff like that. But the zooming out a little bit, if we wanted to say, hey, let's say we want to, start fundraising in 6 months. We want to take, most of this year to really flush out this media empire. What would we, working backwards, what would make a really strong deck? So part of it is just, I'm just riffing and then I'll get your insights or reactions. Part of it is, really flushing out the media story. So having this company diligence machine, having this customer reference diligence machine, right now we're just in chief people officers and chief financial CFOs, but we want to have something for CTOs. We want to have something for heads of sale. We want to have something for sort of the enterprise buyer stack. So flesh out the different sector media properties as well. Really flesh out the Turpentine brand as not just something that gives distribution to customers, but also something that's in the reputation business. Like, for example, you must have seen this. There was this LP survey that went around. Of course, you saw it. That sort of featured which emerging managers they'd want to back, or which GPs they thought were most backable, and that was pretty interesting insights. Maybe we could do lots of surveys like that, and people look to us as like, oh yeah, we're getting the information that's in people's heads on the internet, and that's pretty valuable. So yeah, one is flesh out the media empire, build out the diligence, as service arm to the point where it's undeniable or it's like an obvious advantage. People, without me even saying it, people realize it, or they come to us. And then more broadly, the ducks in a row around, hey, make sure my references are amazing from, and is it just me? Maybe I have another partner, et cetera. Flesh out the team. Make sure the references are amazing from sort of portfolio companies to co-investors to people I've worked with in the past. Get a bunch of them to invest to show their endorsement, um, and then build out the deck and really prove out that, hey, what's our advantage for seeing, what's our advantage for picking, what's the advantage for winning, and just make all of those undeniable, or just sort of obvious, Anyways, I'll pause. Any reaction to
No,
what?
I think it's great. So like I guess like when I think about a deck that feels complete and is compelling, like you want a sense for like what's so special here? Like what is that thing? It's probably going to relate to like sourcing, winning, adding value. It could relate to picking and other things too. But like what is the unique competitive advantage? What's that edge here that's like sustainable? Like if you could just keep this going, like this is going to be true in Fund 5. We're going to have the same edge. Or maybe it'll be even stronger then. So you want like, yeah, some like very clear and simple explanation, like what's the edge? And then you want, yeah, like some understanding of portfolio construction. Um, and like general description of like strategy, right? Like high level stuff and the team and why they have this edge and why the strategy makes sense for them in light of their experience and their edge. But then yeah, like it's like a little more like as much as I can get in a short deck. Like I want to get a sense for like how are you sourcing deals? What's so unique about your sourcing, or what's so unique about your ability to pick, or what's so unique about your ability to win in a competitive setting, um, and like how are you adding value? And then like as much proof as you can muster to show that like I'm not making a leap of faith. I'm not taking a leap of faith here. Like no, you've already done it. Like you already see all these deals. If you just invested in whatever percentage of these deals, or like um, one way I think about this, and I talk to funds who are like thinking about their future funds. Or sorry, like I'll talk to funds like say today they're on a fund 1 or fund 2, and it's like yeah okay, but let's talk about like where this is going, and like what would you want to prove during like fund 1 or fund 2, so that like you're really well positioned for like fund 3 or fund 4. And so like one thing you could be doing along the way, and this is like something that I feel like I talk about a decent amount with folks, is like, what can you be tracking contemporaneously that you're not doing today? It's like you don't have the capital to do it, or for one reason or another, like you're not doing it today. It doesn't make sense now. But if you had the capital or whatever you hope to have at the time you're raising fund 3 or 4, like what would you be doing with that capital? Just act like you have it today. Just don't actually do it because you can't actually do it. So like if you were saying like, hey, I want to be able to invest, um, you know, our reserves. I want 50% reserves, and I think I can invest it into our 5 best companies. I'm like, that would be amazing if you could do it. Today, your fund, let's just say for the hypothetical, is too small to like allocate 50% to reserves. You're not going to do that. So it's like track it today. If you had those reserves, how would you be allocating those? When would you like track it contemporaneously, like every quarter? This is a company. This is one of my 5 companies that I would follow on into if I had the capital. I would do it right now if I could. I would be trying to buy out my ownership, or I'd do it I'd do it the next round. Like track it contemporaneously, and then when you're raising fund 3 in like 4 years, let's say, we can look back and we can say like, hey, actually, like Erik, he knew early, and he was more often than not right about that. He actually seems like he could do that at a really high level. Like, he should be able to concentrate reserves in his best companies. Okay, great. Like that's compelling evidence. And so, I mean, it's counterfactual, and I guess like it's possible people can just make it up. But like if you're actually doing it in like as you go contemporaneously, like I think that's compelling. So then the question would be like, okay, if we're talking about starting this fund like 9 months out or further out, like what can you track now that will help people get comfort in your ability to do whatever they're underwriting you to do? So like, can you start tracking like, hey, we would have sourced great deals. Like, hey, we asked the founder at the time if we wanted to participate in this round, we could have gotten X percent. Like, obviously we weren't, so like we're kind of making it up. But like, would you have wanted us to lead? Like, would you have picked us? I mean, it's hard. I don't know how much weight you put in something like that, but like, prove out as much as you can, and then when you go to raise the fund, you're like, well, we think we can do this because like we've been doing this,
Right.
and like had we had the capital before, we would have most likely been able to do all the things we're telling you.
Yeah.
And so like now we're just we're coming for the capital, but you shouldn't have to take that many like leaps to believe in us.
Yeah, no, I think it's I think it's a great point, sort of proving out, hey, over the next 9 months or whatever it is, what are we sourcing? What are which ones are we betting on, or would we have bet on? And to the extent that we have the relationship with the founder, like, could we have gotten more in? And or would they be willing to say, whether the LP takes stock in it or not? Hey, yeah, I would have let them lead. That would have been great. That is great feedback. It also begs the question of, it is interesting, like, let's say this happens, you get the first fund off the ground, like, where does something like this go over time? And we see different funds do different things. Some just, I guess very few these days, but just stick to their knitting and or grow up to a certain point and just say, hey, and maybe Sousa is an example. We've got our model, we're just going to rinse and repeat and just absolutely crush it. Might evolve, get opportunity fund, etc. But they haven't become a multi-stage fund. They're just still focused on seed. And then you have obviously these are the most ambitious, the Thrives and the A16Zs that start as 40 million or a couple hundred million, and then scale 100x plus. And then you have some in the middle, the NFXs, the Felicis, that get to 500 million, 700 million, sort of combination. I guess their own version of multi-stage, but it's not as flushed out. That doesn't have to be figured out in a day one necessarily, but people will ask, and I'm sure you think you as an LP think about, hey, is this a fund that I'll be working with for the long term? And I imagine someone like you would want to hear, ideally stick to the knitting, right? You want ambitious in multiples, less in fund size, or how do you think about it?
I mean, well, I don't really. I mean, I feel like it's not fair for me to like create other, like, I don't get to dictate other people's dreams. Like, I just want people to be open with me. So like, if people's dreams are to like raise bigger funds, like, I think I could make arguments why staying on the smaller end makes sense, and like I could make arguments that justify, certainly like economically, why it makes sense to grow. And so like, I don't, sure, it's very appealing when folks know what they're good at and they stick to the things that they think are they're uniquely positioned to do at a high level. So if someone's like, I really think I'm a great pre-seed investor, like that's where I'm really special, and here are all these reasons why. It's like, okay, well then, like, if you're gonna raise like a much bigger fund and you're gonna move to a slightly later stage, like, I guess then I'm gonna wonder, like, at some point maybe like your skills evolved and you felt like you were really uniquely positioned actually to not be pre-seed but to be like a later stage investor. Maybe that's true. And I mean, it doesn't mean it's the right product for me at that time. Like, they have moved out of my strike zone, but like, that doesn't mean they won't be a great fund manager at that stage. Maybe they will be, but yes, like, I'm certainly drawn to people who know what they're good at and stick to it. And yeah, like, selfishly, I want all the best people to be like in my strike zone and want to work with Slipstream. And so then like we can invest in these amazing funds and they're just really good at what they do and we can just re-up through programmatically. I guess that would be great. And it's just not how venture works. And so I think what's more important than saying, I guess, like, what I want to hear is like saying the truth. And like, the truth in my view for many people is like, I don't know. And I want to see how this plays out. And I want to see what's working well and what we're good at and what sustains us and like keeps us energized. Because like, let's say, like, you could say like, Alex, you want everyone to stay at like the pre-seed, seed, small fund land, high ownership relative to fund size, just rinse and repeat, keep. But like, if they get bored, then no, I don't want the funds where they're bored. Like, I want the funds where they're excited and engaged and hungry. So I'd rather folks say like, here are the things we're thinking about. I don't know where this is going to go. Like, we're going to be opportunistic and we're going to be open and we're going to be building in ways that take advantage of what's unique about us and where we think we have an edge. And if our edge is evolving or if our edge is deteriorating, like, we should change. We should adjust. So I don't think about it in like there's one right answer. I think it's like, I want their honest, thoughtful reflection on where they want to be. And then like, we all have to be fair to each other. Like, they might say one thing one day and like 3 years down the line, like, things change, and that's okay. That's totally cool. So
Yeah,
like, things might change for me. I don't know. And I'm going to be open with them. So like,
totally.
so yes, it's certainly appealing when people say like, oh, I'm just going to stay small forever. But like, most of the time when people say that and it's not really like doesn't feel thoughtful or like reflective, like sometimes it doesn't seem as credible either. It seems
Right.
like they may just be saying what they think I want to hear.
Yeah. Yeah, totally. So yeah, it's worth having some humility of like, hey, I might have a direction of what I'm thinking, but also, the market might change, my life might change, interest might change. We'll kind of see, and that just have to, leave some.
Yeah, and it reminds me of like a question that was addressed often at QED, which is like it's like it's easy to say like looking back 15 years there was some grand plan, but like there wasn't.
Right.
Like QED has been opportunistic and thoughtful and like changed incrementally and like adjusted to what's going on in the field. And I think that resonates with me.
Yeah.
And so if someone were like, no, I'm always going to do this, I'd be like, whoa, but like venture's changing. Like venture's
Yeah.
going to change again. It's going to always change. So,
Totally.
but anyway.
Cool. Well, gearing towards closing, I do want to be mindful of your time here. Is there anything you think we haven't chatted about, or any other thoughts that you have that I should be thinking about? This has been pretty comprehensive, so I'm not expecting anything. And it's, you're thinking about this for the first time, just jamming with me.
Yeah. Yeah.
You've been very helpful. And so, but I just wanted to give you the floor in case there was anything else.
No, I think nothing's coming to mind off the top of my head. I think it's been really thoughtful, and maybe I'll have more ideas and I'll shoot you an email, but I think this has been a great conversation.
Awesome. Well, Alex, thank you for being an awesome riff partner, jam partner. I appreciate you coming on with very little previous, knowledge about what I'm up to, and sharing some wisdom and immediate reactions. Has been very helpful.
Yeah, thanks again for having me on and for thinking of me.
Turpentine VC is a podcast from Turpentine, the network behind Moment of Zen and Econ 102. If you liked the episode, please leave a review in the Apple Store or rate us on Spotify.